All right. Well, let's get started. Happy to have you all here. I'm David Musto. I'm the faculty director of the Stevens Center, which is hosting this event, and we are proud to have Matt Levine and Jeremy Siegel here. Two men who need no introduction, but I'll just say a couple words. Matt, you guys probably all know Matt's writing. I find that when I teach my class and I ask who saw what Matt Levine wrote about this, over half the hands go up, and it's great for me because I teach a class that covers all corners of the capital markets, and you think it's almost impossible to make preferred stock exciting, right? Almost, but we have Matt to bring preferred stock to life, bring any corner of the capital market to life, and also educate us about if we want to be financial criminals in the future, how we might actually get away with it, though I understand it's never legal advice. So I had Matt, and then Jeremy. Jeremy's my colleague of many, many years, taught here, I don't know how many students. Jeremy, is it 8,000, 10,000? Wharton students over the years, taught the core class for MBAs for many, many years, a legend here at Wharton, and a dear friend to those of us on the faculty. He was a big part of being a professor here, too. And both Jeremy and Matt are commentators on TV, radio, everywhere on the financial markets. And the way we want to do this is a lead off. Just they can we chat a little bit before we take questions. But the main goal here is to take your questions. We'll have mics running up. People on either side with mics and ready to answer your questions, macro, micro, whatever it is, we got it covered here. So let's just start. And so go ahead. Thanks.
Well, thank you, David. Very happy to have Matt here. It's quite interesting. Matt, as you know, is micro in the sense, studying the nitty-gritties of, which are really important, of how capital markets work, how they're regulated, how do you engineer proper mergers or non-proper mergers, and what kind of regulation. And as many of you know, I'm a macro person, looking at the whole markets and from the big picture. So we really have an interesting complementarity in terms of this topic. When we were discussing the topics, we decided we were going to start on two topics. First, we're going to start on banking, what's going on in banking. We had SVB in March, the collapse there, the FDIC and the Fed really sort of stepping in, and now there may be another crisis, and what is going on in banking. And then we thought, hey, why not crypto? What's going on in crypto? And then after those two topics, we are going to open it up to you people. So, shoot away at anything you want to ask. So, Matt, tell us your view of, what has transpired since March and what you think will transpire in the banking system going forward.
I think that what happened in March, which was essentially that SVB and a couple of other regional banks blew up because they had put a lot of their money into duration, and when interest rates rose rapidly, their deposits fled, and they had huge mark-to-market losses on their long-dated bond portfolios. People noticed that, and they're like, oh, this bank is insolvent. It's bad for a bank to be insolvent. They took their money out, and these banks collapsed. When that happened, there was, I think, in a lot of corners of the financial world, sort of incredulity that they didn't notice that they didn't worry about putting all of this money into long-dated bonds in the face of, widely predicted interest rate rises.
When you say they,
there was incredulity by commentators and investors that the banks didn't, and the bank regulators weren't better prepared for this, and that they weren't. It didn't occur to them that on some pretty simple math they would be mark-to-market insolvent if rates went up, and then rates went up, and they were mark-to-market insolvent. And not only were they mark-to-market insolvent, but that had what seemed like pretty predictable bad consequences, like everyone taking their money out and becoming, actually insolvent. And I think that what's happened since has sort of helped to bear out why they didn't notice that, which is that, like, broadly speaking, everyone expects rising rates to be good for banks, and broadly speaking, rising rates have been pretty good for, like, at least the bigger banks. And there's a sort of classic story of, like, the deposit beta is less than 1, and you lose, your cost of deposits goes up slower than your interest, income. And for a couple of the regional banks, that was a disastrous inflection point. But otherwise, it's been largely a tailwind for bank. But there's variation on that too, and, like, some of the bigger banks had made bigger bets on duration and ended up in a worse place. But I don't know. Broadly speaking, like, I've written about, there's sort of two views of this. There's like the capital markets view, which is that if you borrow short term to buy a lot of duration and then rates go up, you will very predictably become insolvent. And then there's the banking view, which is like, no, rates going up is good for banks. And there's been some tension between those views, with both of them kind of being true.
Well, I just don't understand why banks should be betting on the term structure. They're bad at it. They're very bad at it. I mean, banks, I always thought banks should be making their money off the margin. The cost of deposit short term, and they assess the credit. Credit accessibility and their expertise in that matter should be the source of the profit of the bank, not betting on the term structure.
So I think that there are two, there's like a sort of macro, there's like a theoretical and there's a practical answer to that. One, like, the theoretical answer is that, people look at these bank deposits and say, like, the term structure of your deposits is actually not, it's not literally overnight. Like, you don't lose your deposits overnight. And so you can
treat them as more than
instant. Treat them as, and so you have sort of like this model-driven view of, like, what the duration of your deposits is. And it's like there's a lot of science to it that it is not,
But it's not
robust.
20 years. It's not 10 years. Necessarily 10 years
right.
the way SVB. What was the maturity of their bonds?
The duration on their bond portfolio is like 6 or 7 years. Part of it is went up because it's like mortgages that the duration goes up as rates go up. But the other answer with SVB is, like, there's just like a particular structure of the businesses they banked where, in the boom times for Silicon Valley, their client base had tons of cash and relatively little need for credit, right? And so they couldn't, like, money was coming in the door faster than they could put it out in credit to their, like, startup clients who, like, one, had a ton of cash, and two, had, like, no collateral. We're not sort of traditional borrowers. So they were making loans to, like, startup founders, making loans to wineries. But, like, ultimately, one reason I think they were stretching on duration is that they just couldn't stretch on credit because, like, the people they talked to just had too much cash.
Yeah, but they could put in treasury bills if they wanted to, right?
But that's not. You're not earning a margin on credit then. Like, those bills.
Well, I don't know what they were paying on those deposits. So
they weren't paying that much, but they were paying.
So they
were building nice branches. They're providing nice customer service to these, like, customers who seemed like really good customers.
Was it Hans Tile who tweeted that they're insolvent, take your money? It was only like, it had to be the Silicon Valley people who said, the normal person doesn't, know, they're insolvent, take all your money out. You're not insured over the FDIC limits. It had to be the Silicon Valley people that were engineering.
There was very much, they were like, Twitter, but also like Telegram chats between founders saying, take your money out.
And the regulators, passing by all the mistakes that the bank itself and the management made, the regulators seem to be totally caught by surprise on this. Would you say yes?
The regulatory postmortem is kind of grim, and it's.
Well, the Fed actually did a mea culpa. They actually did the study and said, we failed.
Yeah, and I think that, like, part of it is, I think that there was in the supervisory apparatus a little bit more expectation that deposits were stickier than they turned out to be. But part of it was examiners did catch and identify a lot of these issues and then not raise them forcefully enough, or not raise them to the bank, or not make the bank correct them. And so there's like a sort of bad paper trail regulatorily of, like, people saying, they should really not be taking this much duration risk, and then them not doing anything about it.
There was rumors, and I tried to find confirmation that the Fed did stress, the Fed does stress tests on credit quality and default rates and all that. So there's a question of do they do stress tests on maturity risk? And I read one place that, yes, they did a stress test on maturity risk that a 10-year bond would go to 2%. And of course, it went to 3, 4. Now it's almost 5. I mean, it was almost unbelievable. The extremes. I mean, the limit that they did on. And again, I heard this several times. Haven't found the exact one, but I mean, the Fed has admitted that it really failed in terms of warning on that.
Yeah.
Jeremy, can I toss in one question here for both of you?
Yeah.
So think of our students here looking ahead to the economy and deal flow coming up. Are we going to see a rash of mergers of regional banks that their franchise value comes from their low deposit beta and the fragility now is too high, and what we're going to see is a series of mergers? Or what do you think?
I think it's huge mergers. We're the most overbanked country in the world by orders of magnitude.
Yeah, if you had asked me that question in April, I would have said yes. Of course, we're the most overbanked country in the world by orders of magnitude. The relative lack of regional bank M&A since then is a little puzzling. I don't know. There were some shotgun marriages, and then that was it.
Yeah, but the question is now with the rates and people that hire for longer, and are they rolling over? I mean, this is going to be a small. They may have to realize the loss in other ways, in the sense that so many, from what I understand, of these smaller banks did lend on commercial property,
right.
And to the extent that the rates stay this high, these commercial, the borrowers are nowhere going to pay. So they're going to end up with owning property at a fraction of its value, just like the bonds are a fraction of value, and people are going to see that they're technically bankrupt, and then some big guy is going to swoop in and buy it at 10 cents on the dollar. And
I think that's
whatever.
right. I mean, one thing I thought about the March crisis was that it's not a question of lower rates or higher rates. It's the very sharp transition, very much unsettled a couple of very fragile, sort of very duration-heavy regional banks. And so that is sort of not a chronic problem. That just blew up some banks and then it's over. I think the next shoe to drop is credit.
Shoe to
right?
drop
The next
is
shoe to
this
drop,
other shoe, which is a slow train wreck, I think.
It's not like rates moved up and your mark-to-market is solvent. It's that your credit book is much worse because your borrowers can't pay the rates that they now have to pay.
Yeah, they can't turn it over. I mean, if they had 2-year, 3-year loans or whatever, I mean, I've talked to realtors, say, I can't turn over at these rates. I mean, I'll give it back. I'll give the keys to the bank. So what's going to happen then? I mean...
Right. I mean, the March crisis was sort of exciting and fast-moving. This is there have been a lot of articles about the commercial mortgage wreck coming, and it's hasn't really come yet, but it's starting to...
Yeah, I mean...
borrowers are handing back keys.
How do you think that's going to affect M&A and all that? I mean, what fraction of M&A is done by the smaller banks versus the larger banks? And I don't have those figures.
I don't know. I mean, one thing is the prospect for it is so clear that as a policy matter, the least favorite outcome is for the big banks to roll up smaller banks. Right? It is so clear that they'll do anything. The Fed and regulators and frankly Congress will do anything they can to prevent
They do,
that.
but then why won't we shouldn't be like the rest of the world that has 6 or 7 banks per country? I mean,
lobbying influence.
I understand why they want
I don't think
to,
there's a
but I mean,
principal reason for
is that bad for economic efficiency?
My bias is that it is. I think that there is a notion that there is a lot of local knowledge embedded in regional banks where they are making loans or providing services that a big bank branch could not do because they are nimbler and more, have more
But the
local
branch
knowledge.
should have the local
Yeah,
knowledge.
I don't know. That's what people say.
Yeah,
A lot of lobbyists.
I mean, that's the people that say the lobby for the small banks, right?
Well, another question that comes out of this is what should deposit insurance be going forward? What do you think, Jeremy?
Well, You mean like FDIC insurance?
Yeah,
I mean,
what do we get out of having the limit where it was through this event?
That's a good question. I think it should be. I think it should be unlimited on banks' payroll account. I mean, corporations that have payroll accounts. Splitting it to make 250. There should be certain accounts where basically they should all be. And in fact, I would say that you could probably make it unlimited unless you can see signs of fraud. That's what you worry about. Someone putting in $1 million, make a loan to something that's bad, and then going to the FDIC and getting paid off. Unless it can be shown to be fraud, I think you have to extend this. I mean, it's de facto extended. It's de facto extended.
Well, would that then just be too expensive for banks to have to pay into that deposit insurance fund for unlimited?
No, but if they monitor it, for fraud and everything, I mean, really the amount the FDIC, it was trivial how much was paid off. I mean, I remember back in the 80s when the savings and loan crisis, that cost the U.S. government $115 billion back then, which is like $300 billion today. This was like 1% of that or 2% of that. I mean, that was a real abuse crisis. And yet, next 40 years, the banking system survived.
And I kind of agree that it's now de facto unlimited in a way that is poorly executed, where people do run on banks because they're not sure it's unlimited. And Janet Yellen says,
"Well, yeah,
it's unlimited," but she doesn't say that, and so people don't believe it.
Yeah, but if they had some set rules about again against the fraud, that's what you really worry about.
No, it's hard because you can't tell depositors you get your money back unless your bank is doing fraud, right? That's not a function.
No, it's someone who puts the money in to take the deposit. I mean, it's someone. I guess you could think about, they have to monitor that to some particular extent.
I think unlimited deposit insurance requires a higher level of supervisory attention because there are arbitrages of you're a bank and you're like, oh, unlimited deposit insurance, I'm going to take a lot of deposits, pay 5% and do crazy stuff with it, right? You could do that with limited deposit insurance, and then it's just a matter of supervisors have to monitor you. There's a higher bar for that in a world of unlimited deposit insurance, but it doesn't seem like a change in kind.
Yeah, but even during the financial crisis, the FDIC didn't pay out anything, did it? I mean, really, if you go through the history, it's been very profitable. It hasn't cost taxpayers anything, and it's almost been de facto everything anyway. So.
That's what I had thought, but I don't think that's really true. I think there have been some
big
not
payoffs?
large, medium-sized failures that were not fully insured.
I'm not sure.
Itamar, go ahead.
We're talking about this once in class. If you looked it up, the average cost of deposit insurance per dollar, they charge it per asset, $1 assets rather than deposits. Those are pretty close. Is 2.7 basis points a year. And as Jeremy said, take the SNL crisis out of it, it's been largely self-financed. So sometimes, there's a lot of discussion about whether you should extend it or not, but at the end of the day, it's costing 2.7 basis points per dollar. Even if they raise it to 3 basis points, 4 basis points, it's kind of been something that's been almost free. Usually the cost in terms of moral hazard of something is proportional to how much moral hazard of use occurs ex post. So here, how much we have to actually pay out in deposit insurance and stuff that went down. And historically, taking SNL crisis out, it's just been very small. So historically, it's been kind of almost a free.
Yeah.
Right. And the moral hazard stuff is all the most intuitive way to address it is with supervision rather than right.
Yeah. And as I said, we've had it for decades and decades and decades, and again, outside of the savings and loan, I don't even know how that figures in if you add it, but it's been profitable.
Was there a question there? Sorry, go ahead, please.
Incentives.
because I don't think that like bank deposits are like a bubble asset, right? Like I think that like the risk, the moral hazard risk is not that like people will deposit too much money in banks because they love the free insurance. It's that banks will take insane risks with their deposits, and I think the answer to that is some combination of like insane banks still have ways to accrue financing even without unlimited deposit, like, like broker deposits or like, capital markets financing. And supervision is designed, like the way to stop banks from taking insane risks is like, in the first instance, I think, supervision and prudential requirements rather than like limiting their funding. But no, but I think that is the right objection. It's just like, I don't find it super compelling.
It was interesting because Bank of America just reported a couple days ago, and they took over $100 billion paper loss. Right. I mean, they're big enough to absorb that without getting a run on the bank, but they're again, stupid bets on maturity risk right there that cost a big bank a lot of money. But
I think that like the fact that Bank of America did it, and by the way, the big competitors didn't.
Yeah,
it's not as stupid as it sort of looks in retrospect, right? And it is like banks in a world where they had a lot of deposits and needed to stretch somehow, and didn't have the capacity to stretch on credit, I think.
Yeah, I mean, okay. Shall we shift?
Well,
or is there one more question on the bank?
Move on to crypto here.
Yeah.
Right, go ahead.
All right, Matt, tell us about your views on crypto.
I love crypto. So I love writing about crypto these days because, so when I started in financial journalism, it was like 2011, and it was a perfect time to write about the 2008 financial crisis because all the enforcement actions were coming out. And so you could get the power of the U.S. government to investigate what went on in 2008. And so you could get the guts of these terrible CDO deals that blew up and that were sort of very salient to the failure of the financial system in 2008. And in crypto's 2008 was last year, and the enforcement actions moved a little bit faster because all these people seemed like they might be fugitives. And so crypto's 2011 is now. And so we're getting all these enforcement cases and bankruptcies and fraud lawsuits. And it's fascinating because, so two things. One is if you're interested in financial crises, 2008 is this incredibly rich and interesting series of financial crises, but it's quite complicated. Crypto made a toy 2008, so it's you can sort of see the whole shape of it, and you can see how financial crises, or how the collapse of levered financial institutions work in a much smaller, simpler, more comical, four guys doing it kind of way. So it's really it provides a lot of insight into the intuitions of how 2008 happened, how banking crises happen, and the other thing about it that I think is really interesting is that if you sort of look back to the dawn of crypto, it came out of 2008, and it was designed to, it was a reaction to the financial crises and hidden leverage of the traditional financial system. And it was the problem with finance is that your money lives at a bank, and the bank is doing all sorts of moral hazard with your deposits. So we're going to not have your money live at a bank. We're going to have your money live on the blockchain, and you're going to own it without any intermediaries. And there's no need for this sort of embedded leverage that traditional finance has. And then people liked that, and so Bitcoin went up. And then people from traditional finance were oh, it went up. I want in on that. And so they just, they came and had no philosophical commitments, and they came in and they're this is good, but it would be better if we could lever it 20-1. And so then they just recreated all of the opaque leverage of the traditional financial system. But again, it's four 30-year-old guys doing it with no regulation offshore. And so it's much worse and much less regulated.
But you're not saying that Bitcoin itself is,
no.
a levered asset. You're
Oh, no.
saying what was
I'm saying that like
people
the
abused and lent out deposits like.
I'm saying the crypto crash of 2022 got very far away from like the sort of like, original philosophical underpinnings of Bitcoin, and, had a financial crisis, and also like that like reverberated to like things like the price of Bitcoin, because the price of Bitcoin was kind of propped up by the levered financial institutions of 2021, and then when those institutions all blew away, the price of Bitcoin went down.
Okay. We should also remember that NASDAQ from the year 2000, 2002 went down 80%, which was much more than Bitcoin went down. So,
Oh yeah.
I mean,
I don't,
right.
I don't mean to suggest that like this is fatal for crypto.
That people were abusing it. We're not talking about whether Bitcoin itself, in and of itself, is a good or bad thing, right?
Oh no.
What's
But I
your
think
opinion on that?
I don't have one.
You don't.
I mean, I don't have one. I truly don't. Like I don't. I have in 15 years of crypto been somewhat underwhelmed by the realized goods of like what crypto has produced. I think that, but I'm also like fundamentally an efficient markets guy, and one realized good that they've produced is like a thing that is fairly durably worth $30,000, and like that's pretty cool, right? Like that's like, and that is, it's one thing for me to say like some online enthusiasts will pay you $30,000 for this thing, but like it's creeping into institutional adoption and mainstreaming in various ways.
I think Bitcoin is really a response to the sluggishness of banks and financial institutions. We should have I've always said we have the technology that we should be able to transfer with 2 or 3 basis points between all accounts, merchants and everything else. And the fact that, credit cards are 250 and at 300, we get 200 back. It's crazy. And then, of course, the Durbin put a limit on debit cards because they were trying to do that, the monopoly, Visa and MasterCard. The cost of doing international transactions is ridiculous. You go on and on. It's like, let's get rid of this nonsense and have a 24/7 world currency that can be instantly transferred. And now we could talk about what the bid-ask spreads and the cost could be and all that, but my feeling is that
I do think
if the regular banking institutions had become more responsive and less cushy and not ignoring. People. So many people want to disrupt this terrible financial system that we have.
I think that's all right, but I also think that some of like what like the crypto like value proposition is a little bit of sleight of hand, right? You can say all these transfers are free, but like when you think about like how it works, like you have a ledger that instead of being maintained by like the Fed and like some big banks, you have a ledger that is being maintained by thousands of distributed computers. Now that might be more efficient than having the ledger maintained by the banks because the banks like have fancy buildings and whatnot, but it might be less efficient because you have to have thousands of copies of the ledger instead of one or whatever. And then two, like the way that like Bitcoin transfers, for instance, are free is that miners mine blocks and are rewarded with like essentially like additional Bitcoins. And so that's like a sort of like inflationary mechanism. And as long as the price of Bitcoin
but it's limited, so.
Yeah, but like as long as it's limited.
It's asymptotic, so we know what the limit is.
It's asymptotic, but like then you think about what happens in the world where you're basically at the asymptote. Do miners do this for free? And empirically, miners do not do it for free.
Then it's a fixed supply, and they don't do it anymore, and there's no.
No, but you need someone to maintain the ledger, right? So you need to charge transaction fees, and it's not obvious that the transaction fees are lower than like Visas. Well, I think that like Bitcoin sort of hides the people who are getting paid to do the transfers in a way that is very easy to hide as long as the price of Bitcoin is going up, because it's like effectively inflationary. It's like, who cares? The thing doubled, right? And I think that like in the steady state where you're essentially paying for transfers with transaction fees, it's not obvious that Bitcoin is cheaper. And in fact, people in the crypto world like are keenly aware of this, and there's a lot of like building of like layer 2 blockchains to avoid the essential problem of like every transaction has to be validated by thousands of computers, and that is just necessarily like from first principles less efficient than like JP Morgan's spreadsheet doing it.
I'm curious also, just you talk about the steady state of Bitcoin in the future and how right now so much Bitcoin is held by a few big players. And are these guys really going to hold something that's not volatile, that doesn't have the promise of a big return? And then,
Well, I think the biggest disappointment of Bitcoin, it's supposed to be an independent asset class, and yet its correlation with NASDAQ is 0.95. I mean, it ain't independent. I mean, and of course they try to sell it as an asset class, and asset classes are supposed to have independence with other risk assets. That gives you the diversification.
yeah.
And I mean, that was the big failure. I mean, because I do think about asset allocation and all that is, buying something that's correlated completely with NASDAQ, that doesn't excite me. I like something independent. Now, theoretically, it should be. I mean, why should it be correlated with NASDAQ? I mean, if it's a digital currency or digital gold, which isn't correlated with NASDAQ, I mean, it shouldn't be, but who owns it or, how they think of risk is such that it is correlated with. The bottom line is it is correlated.
I think it's a lot of that. It's a lot of like the psychology of the people who hold Bitcoin and like also buy Tesla is quite correlated. But like, I also think that like broadly speaking, crypto is a bet on an emergent technology, right? I mean, it's a bet on a new technology. It's it's like buying Stripe stock, right? It's like a new payments technology.
Yeah.
So I think that there's reason, and that's true of Bitcoin, but it's like especially true of like sort of second generation crypto that is like funding projects to build stuff rather
Matt,
than.
do I detect you want to talk about Elon Musk?
Before we get to Elon, any question? Go ahead. Yeah, please, right there. Yeah.
Thanks for coming. I had a quick question. You've written a lot about Gemini, Tether, a lot of other projects. I'm just curious in the crypto space, is there one that you found particularly interesting? I guess a quick follow-up to that is SBF is going on trial right now. You gave a platform for when crypto was much more hot. So I'm just kind of curious, like, do you have any opinions on that for spectacle and your time with it?
I mean,
I don't have the expertise. Do you?
yeah. So your first question, projects I find interesting. I mean, FTX is endlessly interesting. I find Tether fascinating in so many ways. Tether is obviously the best and simplest business in the world if they just leave it alone, and they just like constantly stumble around being like, we're not doing fraud here. Your money is safe in that secret place over there. It's so weird because if they just kept the money in a bank account, they'd be like the richest people on earth. So Tether fascinates me. I think that like like eventually someone, and it's not me, someone will eventually like tell the story of like what is going on at Tether, and it'll be amazing. But I have nothing really insightful to say about it. I just think it's fascinating. The SBF trial. What can I say? I mean, like, I think that the thing that Sam Bankman-Fried did really well was pitch his whole persona to appeal to people like me. He was.
Did you interview him ever?
Yeah, I did a couple of. Now I've been played at the trial. I did a couple of now notorious podcasts, and a really interesting. So I did like 2 podcasts with SBF. One is the one that was played at the trial, which was not interested in anyone, but we talked about crypto market structure. And he, like, as an aside, was like, we've never had a losing day with our risk engine, and like that turned out not to be true and like an important fraud. So that's one. I did this second podcast with him that became famous where I asked him about yield farming, and he like described this nonsense, and I was like, you just said you're in the Ponzi business, and everyone quoted that forever, but not at the trial. And the third is I did like there was a Bloomberg crypto conference, and I want to say August something like that, in the summer. Like, I remember, like he wanted to, like they wanted him to come to it, and he was like, "I'll do it if Matt interviews me." And I was like, "Sure." And so I interviewed him on stage. It's the only time I've actually met him. And I remember introducing him. I was like, Sam Bankman-Fried, it was like this crowd of crypto people. I was like, Sam Bankman-Fried needs no introduction. He probably bought your company last week. Like, that was the vibe. It was like every crypto firm had just failed, and he had bought them all. And so that was fascinating because I talked about, like, why are you doing that? And I was like, is it because you want to prop up the price of crypto to keep your machine going? And like, yes, it was. And he kind of said that. But I don't know. I mean, like, he was pitched to appeal to me because he was not a crypto evangelist. In that the yield farming episode, I was like, I was struck by his cynicism in talking about like the purposes of crypto. He was like, the number goes up and I make money on it, right? And I think that was sort of, that made him seem credible to people like me who were like interested in crypto, covering crypto, but came from a traditional finance background and thought like a lot of the people with like the funny hats and the weird vests were like didn't make any sense. And he was like a guy from Jane Street who made sense, you know? And I think his like background in traditional finance and all of his like tics that I think play as like weird in the media also played as like normal to finance people. It was like, yeah, he like is at his computer a lot and his hair is weird and he like does math. Like, okay, that sounds good, right? So I think that it was like well calibrated to appeal to people who would otherwise be skeptical of crypto. I think he was a really good talker. Like he was really, you know, he seemed thoughtful and convincing about like.
Matt, did you read Michael Lewis's book?
I did.
What do you think?
Look, I liked the book. People are mad at the book because they felt it was too generous to. I don't think it's not hagiographic. It's Michael Lewis is enamored of his characters, right? And he thinks Sam is probably more interesting than he is, but he does not really defend Sam. Like he kind of paints him as a scammer, in a way that I thought rang truer to me than a lot of the more just yelling about it, you know? Like I thought the picture that he painted was like of a guy who is a classic scammer in the sense that he's not like sitting around cackling being like, oh, I'm stealing all this money to buy real estate. He's like, oh no, I'm not taking any, like this is perfectly safe. I know this will work out, right? Like that's like a very classic way for a scammer to work is to sort of like deceive yourself about what you're doing with the customer money and be like, oh no, this is fine, this is what they want, it'll be good for them, right? Like that's kind of how most financial crime happens, I think. And so I thought that was a realistic picture of him. I don't know if that answered your question about what I think about him. That's a great question that I don't want to comment on. I don't know. I mean, I have no idea. I have no inside information. I think that like the thing about Binance is that they're less interested in appearing legal than FTX was, and they have. I think they're clearly. I think they're somewhat clearly taking fewer dumb risks, but I do think they are fundamentally a levered futures exchange in crypto. And that's like a fundamentally rickety business, right? Because like crypto prices are volatile and like your business model is like, I'll give you 50-to-1 leverage and you know, probably be able to blow you out if it goes down. But like, I don't think the odds of them being next are zero. But I think there's two things, right? There's like, it's a levered crypto exchange. I assume that it's relatively legitimate, but that's still a fragile business to be in. And then there's the separate question of like they are doing crimes, right? Like they're you know, like I assume they're not stealing the customer money or whatever, but like they're also, you know, not like as interested in complying with American AML laws as, you know, the average bank. And so will the US try to shut them down in an aggressive way for doing crimes? I mean, like, yes, a little, right? So, I don't know.
Inamar, did you say?
Yeah, and I've heard you write one thing I thought was interesting in the cycle, but you didn't bring it up this time. You're bringing up the levered part, which is that in part it seems, at least the narrative, I don't know if that's the reason, but the narrative for decentralization and blockchain and system, we can't trust the bank. But then a lot of what's sprung up involves putting way more trust in things without any verification or regulation or centralization than there was putting in the financial system. Just the thing you wrote today, also, because I've had friends that do this, you can, normally do a wire transfer, you pay someone, if it turns out there was a fraud, you can reverse it. But here you just send it to like the wrong place and you're not getting it back. So there's like a humongous amount of trust that's required, despite and it's turned out badly, despite the intentions, the narrative is that you don't need trust.
I think that like the intellectual framework for this is scams, right? And like online conspiracy theories, right? I think that like the thing that just makes people gullible, makes people let their guard down the most, is someone telling them, you're too smart to trust the system, right? Don't trust those guys. Those guys, like, you know the real answers, right? And then you're like, okay, here's all my money, right? And I think that's like a recurring theme in crypto is when Alex Mashinsky is taking people's money for Celsius, he's not saying like, I'm a trustworthy guy. He's saying, don't trust the banks, right? And everyone's like, oh, well, then I'll trust that guy, right? I think that that's like the psychological component that is like really, really important. I think there's like, it's a diverse group, and I think there is in crypto people who are truly not your keys, not your code, not your keys, not your coins, like very like truly resistant to trust. But I think most people can't live like that, and I think that being told you're so smart because you don't trust the traditional financial system causes a lot of people to let their guard down and trust Alex Mashinsky instead.
It's interesting because, in the inflation of the late 70s, gold soared, and we used to call them gold bugs, and they also didn't trust the financial system. There was a certain group of people, and I'm trusting this, any money, anything that's issued by that, I'm going into gold. And it was a similar sort of thing.
Not only that, but they would like have Krugerrands in their house.
Oh yeah.
Not only that, but there's like 50 years of like scammers online selling fake Krugerrands and being like, oh, give me my money.
But
the group that is selected to not trust the financial system and keeps Krugerrands is a rich vein for scammers, and similarly
probably growing, it seems. I don't know.
Another question there.
I completely agree with that. Yes. Yes, completely.
Using stablecoins, right? Bypass inflation. So I think in a macro sense, there is an argument to be made that I feel like institutions, especially like central banks and monetary technocrats, need to be figuring out a way to deal with this, right? Because then things like capitalism will cease to exist. So I guess how do you think of that in terms of like the effectiveness and utility of these institutions rather than replacing these? Or like, if I need to send you money, I can just send for the record, I'm not sending money. But if I need to do that in Argentina, maybe they don't have that.
Well, but then they're thinking going to the dollar, right? I mean, doing away with the domestic currency. I mean, some of the countries have and gone to the dollar, which does still have inflationary bias now and then, but certainly much less than any of those countries. But
yeah, no, look,
dollarizing is another choice rather than going to crypto.
I certainly agree with you, but I also think that like the like the history of like adoption of crypto in like El Salvador or whatever is not like
it's a disaster.
Not
right?
like amazing, I think that like
it's a disaster.
like one thing you're saying is like there should be better payment systems and macroeconomic policy everywhere, and like that's true, right? But like has crypto done a good job of being that system? Like, I think the answer is mixed. Like, I don't think it's completely no, right? I agree with you. There are places where crypto is much more useful for payments than in America because like the alternatives are worse and the crypto stuff is fine. And then you have, some number of those people are losing their life savings on FTX or whatever, and like that's bad too. But right, I mean, it gets to your point of like, should there be some sort of like I think a lot of the U.S. regulatory response to crypto is like, this is worthless and we're going to kill it. And we're not going to say that because people get mad at us, but we're going to do that and no one will get that mad at us. And I think that like, arguably there's a broader view of like, this is not worthless, and we need to find a way to integrate it into the global financial system in a way that is more regulated and safer than what we've had so far.
Over there? Sorry.
Can I ask a question about the media? Is that
Yeah, why not? Go ahead, yeah.
I don't care.
so? I'm sort of thinking about this, that a lot of the frauds have been suborned, or my paradigm is they've been suborned sort of by the media, and I think that two examples would have to be Elizabeth Holmes and SBF. When it's come out in the trial that SBF had this whole persona, and same with Elizabeth Holmes, to sort of attract this veneer of venerability, and they would go into media all the time. There was in Elizabeth Holmes' case, I think that reminds more of ESG, a need to defend her. So I'm wondering how you're in the media, how if you guys can combat that. And the other thing is there's a lack of investigation. Like, sure, SBF went to Jane Street. How did he do that? He left after 2 years. I haven't read anything about, some people go to Jane Street, leave after 2 years because they couldn't cut it. So
So on that narrow question, there's been some reporting that he was doing fine at Jane Street and left. There's acrimony after he left because he left to be like, I'm going to start this like effective altruism charity. And they're like, okay, have fun. It's been nice having you. And then he was like, I'm starting a crypto hedge fund. And they're like, ah. So I don't think he was like fired. I think he generally, I think there's reporting his record at Jane Street was like pretty good. Like he wasn't like the best Jane Street trader ever, but like no one had serious complaints until later. On the broader question, I think issue with one thing you said, which is that people felt the need to defend Elizabeth Holmes. People felt the need to puff up Elizabeth Holmes when she was a celebrity. The minute that turned, nobody felt the need to defend her. People in the you cannot overestimate how much people in the media love tearing people down, right? Like they like a hero, but like if there's a crack in the hero, like yeah, let's go.
Yeah.
And I think that both with SBF and with Elizabeth Holmes, like people turned on a dime to the point where they're like, if you said anything at all, both Elizabeth Holmes and Sam Bankman-Fried's parents have had profiles in recent months where like the New Yorker sat with his parents and the Times, I think, sent someone to sit with Elizabeth Holmes as she was like awaiting going to prison. And they were like humane stories. They were not like, these people are great. They were like, isn't it sort of sad what's happening to them? People got furious at these stories, being like, how could anyone in the media say anything nice about these people? So I think that like the media loves to tear people down. And like investigations, I agree with you that, so I think that like the incentives in media to like do a good investigation and bring people down are like amazing. With the one exception that like the people who brought down SBF really were at CoinDesk, the crypto media company, which got and published the Alameda balance sheet and said, that's weird. And then like a week later, FTX was gone. You know who else was gone? CoinDesk. Like they laid off like half of their newsroom because because they're like owned by DCG and like they like the crypto crash took away all their funding. But no, I mean like, so that's unusual. Usually like when you like expose a fraud, you win a prize and you're happy, right? They did win a prize. I was at like a prize thing where they won a big prize, and they're like, it's a shame that we were all laid off. I mean, the incentive structure is there to expose frauds. I think it's harder, right? And like particularly like if you look at the crypto industry, right? Like there are a lot of reporters who are like, I mean, like Tether, like they just walk around with a sign being like, we're not doing fraud. So like everyone's like, hey, let's look at Tether, right? Or like even like Binance, where like Sam Bankman-Fried was like had his like little notes being like, get reporters to investigate Binance. Like Binance, like looks shadier, right? Like they look like because they are flouting U.S. laws. Like FTX is like, we're complying with U.S. laws, and they were stealing the money. And so there's like a target-rich environment, and people did not think to like, he was not their first target. But no, it's hard, and I think that like one cannot expect the media to bring down all of the frauds. The media has a decent track record of like exposing some frauds before the regulators do, but it's not going to be 100%. I don't know. I mean, I don't have a satisfying answer to your question. You're right that like SBF and Elizabeth Holmes were puffed up by reporters, and that probably helped them steal money, right? I mean, that's true. I'll just say that, like, in my world, I think the incentives to tear people down in media are so much greater than the incentives to puff people up. Like, what do you get from puffing? Like, you get some look. I like went on stage with Sam Bankman-Fried, and he's like, "Yeah, my buddy, this billionaire, right?" Like, you get some benefits out of that, right? Like, you do. Yeah, right. I don't know. Yeah, I guess, right. Like, I could call him up and be like, "Hey, tell me about crypto." I don't know. Yeah, you're not wrong. I don't know.
Is there a question there? Go ahead, yeah.
Yeah, I have a question. First, I want to say, Professor Siegel, thank you for coming. You told my uncle one saw it 25 years ago. I really appreciate it. But my question has to do with kind of the adoption of crypto. So you mentioned that we should be able in this day and age to trade, like send money, exchange money for like 1 basis point, 2 basis points, and we're at like 250. I think part of my issue and a lot of people's fears with crypto is ease of use and consumer side protections. So I send to the wrong address right now. I can't get my money back. It's gone forever. And there's like not really something that makes it really easy to use. Where something like ChatGPT 3, people could have used the API token much earlier, and it only really blew up and took storm when it was like an easy to use interface. So I would argue that part of the reason crypto hasn't been fully adopted or adopted as quickly is the ease of use with these services. There's a lot of services. It's not like Venmo. You can easily send it, and Venmo will cover you. What do you think about that?
Well, I know. I mean, listen, I don't own any crypto, so, I kind of watch it from afar and, think of it as, well, is it an alternative could it be an alternative monetary asset? Could it be the digital gold? Gold theoretically had a limit. Obviously, it could be mined, but that was small compared to the stock. Basically, like Bitcoin could be mined, but the increments are now small. What is 90% is now created? Is that what we know now, or 95%? I mean, it's mostly there. I mean, there were similarities, and it's done digitally. Now, of course, you always fall back on gold. Had the use as jewelry and people ornaments and beauty, which of course the digital did not. So there was this question of, well, is there intrinsic value? And the gold had 5. Then there's a question of transactions cost, and I said, if you bought a Bitcoin right now and sold it right now, what do you pay? And well, I talked to someone yesterday, and I can't swear it's true or not. They said, it's 3%. Well, that's a huge bid-ask spread right there. I mean, that's not going to be good for, as an alternative to transfers. And I said 1 or 2. I was going pretty extreme. It could be 5 or 6, but I mean, if it's 3%, if I buy $1,000 of Bitcoin and sell it instantly, do I lose 3%? You guys probably own Bitcoin. I don't really know. That's too much.
I don't think it's that wide, but
what is it? I don't know. But
it's
more than you can transfer in and out of transfer to someone at 10 basis points, and if you transfer back at 10 points, that's 20 basis points instantly. And you can always. You're right. I mean, there's a question of. It's interesting, the banking system, Zelle was their invention of instantly, just putting in, I'm going to transfer to somebody. They have limits as far as that's concerned. But they also said it was irreversible, and they've gotten into legal problems about that. Because, I mean, and now you have to sign this huge thing about, is it reversible? I mean, you could have a system, by the way, where you have 24-hour recall, and they send you emails and other ways to, is this your transaction, just like credit cards? Is this your transaction before we let it go? That would be comforting, especially if you sent the Bitcoin to the wrong address. If you could recall it within X hours, and should the other person really care on that? There could be safeguards that are built in to make it that. But, I mean, just, again, used to be the bankers 9 to 3 hours, not even 9 to 5 hours, 10 to 3 hours. And, the banking industry is pretty stodgy, and the credit card industry in the U.S. is just like a monopoly. And, there's studies that's costing consumers, something like, $800 billion in terms of, if you had 2 or 3% to every transaction that doesn't have to be 2 or 3%. Now people get it back in rewards somewhat, but it's a lot that's skimmed off. So much inefficiency. I mean, and people try to break through to get rid of that inefficiency. It's really hard because you're up against the U.S. banking system and all the regulation and everything like that, and the Fed, as far as that's concerned. But FedWire, digital coin, digital dollars. I mean, there can be a lot of progress that is made on transfers, and I think that Bitcoin fills some of those voids. I'm not going to say it's great in all circumstances, but I think it does.
To your point about like the consumer unfriendliness of crypto transfers, I think it's like striking that I've used some number of like digital wallet, like crypto exchange, consumer-facing products, and they're terrible, right? They're like, it feels like they're designing for a closed universe of like people who are really into crypto and like computers and like expect a level of sophistication from their end users that is kind of weird. And when I think about like people who are integrating crypto payments in a user-friendly way, it's all, the Stripes and PayPals of the world who are like, oh, this is a thing. We got to integrate it into our already consumer-friendly product.
So outside of this small world of libertarian enthusiasts, people want the trust. They want the reversibility. They want all that.
I'm not sure that PayPal provides reversibility on Bitcoin transactions because, like, that's kind of hardwired in the blockchain, right? The irreversibility.
Question for both of you. If I took away all your professional obligations and your personal obligations, your kids, grandkids, etc., and I gave each of you $1 million, what startup would you create today and why?
I'm not that kind of person, man. I would, like, what startup would I create? Like, what would I devote all of my time to doing in a way that I think I would be like the best at and would like make the world better? I'd type my newsletter, right? Like, that's what I'd do. Like, I've like found my thing, man.
I guess in other words, what gives you the most opportunity? What's the biggest problem out there that's just sitting and nobody's doing it?
Writing jokes about finance. If I had a bigger problem, I'd do it. But
Sell the movie rights, I guess, right?
Yeah, I mean,
I want to write a movie about the sculptor drama, but that's a different story.
I mean, I like, I admire people who make breakthroughs and can think about it and see it through. And but I'm not one of them, so I kind of look from afar. So I don't have an answer to that, I'd go. I know, I've always been on banking regulation, and we should have a better transfer system that's, 24/7, 365 days, and international, all that. But that's the job of individual monetary authorities around the country. I lobby them, but I'm not going in and making it, such that an alternative.
The question there?
So my favorite piece written by you is the moon emoji as securities fraud.
Oh, sure.
If you
It is.
remember that.
Yeah.
I remember reading it on my boss's Bloomberg terminal and losing my mind laughing. And he was just like, what are you doing on my Bloomberg terminal?
You can get the email for free without a Bloomberg terminal. Important piece of marketing. Yeah. Nah,
It comes first on Bloomberg.
like a minute first, but okay.
But, so I wanted to ask about that specifically, like with regulatory regimes. Like, so, obviously, like that seemed to me like a bit of a ridiculous lawsuit, and I'm not sure it's something that the SEC would have brought 5 years ago. The FTC has also sort of taken a pretty...
They didn't bring it, did they? That was a private lawsuit, wasn't it?
Oh, sorry. I mean, just in general with regulatory regimes, like the FTC, for example, is like bringing a lot of lawsuits which they're not necessarily sure that they can win, and they're obviously their win rate has gone down. So what do you think about this sort of being ushered in politically, but where do you think that that's going? Do you think that it's going to change the landscape in the markets a lot?
I mean, I think that like that's a like weird symptom of U.S. political polarization, where like the Biden administration came in with like a set of commitments to advancing progressive causes and being more aggressive on a number of things, of which like we used to call it hipster antitrust was a big one, right? For like the FTC is bringing cases that sort of push the frontier of what people have thought of as antitrust law for the since like Bork. At the same time that the Trump administration came in with a mandate to put a bunch of like 28-year-old far-right conservatives on the bench. And so you have like this dynamic where the regulatory agencies have moved pretty meaningfully to the left of like the long run, and the courts have moved dramatically to the right. And so you have a lot of like regulatory agencies losing cases and like politicization of those cases.
And then you have a the court saying, "Are you overreaching the mandate?"
Oh yeah, but like and just like there are live questions about. I'm exaggerating only slightly when I say whether anything the SEC does is constitutional. Right? There are live questions about whether you can delegate a securities regulatory regime to the SEC or an environmental regulatory regime to the EPA, and those questions were kind of dead for 90 years and have kind of come back to life. So I don't have an answer to your question other than like it's like dramatic, right? I mean, I think that where we are is there is more aggressive regulation and the like lurking shadow of no regulation, right? And so one thing that means is that if you are a Ripple or Microsoft or if you're the target of these regulatory actions, you're much more likely to fight because not only might you win but like you might be the one who like unlocks the door at the Supreme Court for them to say all regulation is unconstitutional, and then like you can do whatever you want. So I don't know. I mean, that's the it's a weird dynamic. I don't know.
Go ahead. Yeah, I tell you.
Well, I think around like Europe limits fees on credit card. So, again, I'm not an expert on this, but Congress limited the fees on the debit cards. They originally wanted to charge like not as much as credit cards, but it was like 1 or 1.5%, something. And Congress said no. I don't know what that is now, 37 base. I don't know what it is, something like that. They limited the amount. They said this is just, and people are trying to bypass through the MasterCard, Visa, American Express system, which is like a triopoly that just controls everything. And if at first they, said you couldn't even advertise a discount for cash, finally, the courts ruled yes, you can. Although a lot of merchants don't want to do it because they feel they might antagonize some of their customers, et cetera, and so on. So we do see it much more than before, though. I mean, restaurants saying 3.5%. Discount if you pay in cash, or surcharge if you pay in the credit card, which is what they pay, and especially in these times of inflation. But cutting costs, 3.5% could mean the difference between profit and loss. So you'd begin to see that more explicitly. But people have done studies show that that these rates that people playing in the electronic world are just absolute. The credit card industry says, oh, we have to protect against fraud, and if you go into the books, that's like 8 basis points of what they're charging as far as that's concerned. So, I look at a thing from a macro point of view. You have a $30 trillion economy, $20 trillion is in consumption, and $15 trillion is in potentially credit card sort of thing. So you have 2% on that. You're talking about a huge amount of money.
Yeah, I've started paying cash a lot more. It went way down, then came back up. It always pays a 3% discount. So I bring cash now.
Right, exactly. I mean, a lot of people say, "Oh, the hell, I'm not going to carry the cash. I could lose it. It could be stolen. I have a record now. Blah 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 blah." But I mean, it is a crazy payment sector, and I think in Europe they limited credit cards and to less than one basis, one percentage point. But I'm not absolutely sure about all the rules. But the U.S. is the worst.
The question there? Yeah.
So, Matt, you have a law background as well as like a finance and banking background. And I think that's somewhat unique in the finance field. I'm curious how that kind of helps you guys in writing.
I write about more law stuff. I read about more law stuff. I don't know. I mean, I think like a lot. I was a lawyer and then I was a derivatives banker on a desk where part of the perspective that I took from working on a corporate derivatives desk was that, if you read a derivatives textbook, it's about like, essentially like allocation of market risk. And it's like you have like this payoff graph, and it's like, oh, if you want this shape of payoff graph, you buy this derivative, right? And I rarely encountered anyone who wanted any shape of payoff graph. You could sell people the shape of a payoff graph. You could be like, oh, look, wouldn't it be great if it's up here, But like the thing people wanted was like to save money on taxes or to raise their EPS by 1 penny next quarter instead of having to wait to the following quarter. And so like what I was doing like had some math, and like we looked at the payoff graph because like we were, it was our P&L, but like the thing we were selling was like largely more or less legal structuring. It was securities law structuring. It was structuring around people's like lockup agreements. It was tax structuring. It was accounting structuring, which is like quasi-legal. And so I always thought of like the financial world as often solving quasi-legal problems, right? And so I write a lot about stuff that is capital rule arbitrage or regulatory arbitrage or things like that, where like the technology the financial system is bringing is to solve like these problems of like legal structure. I don't know. Oh, yeah. I read about this yesterday because there's this fascinating story about EQT in Europe. They have all these portfolio companies that they are sort of nearing the end of their lives, of their fund lives, and they can't take them public because like people won't buy them for the price they want to sell them for. And they're like, we're going to sell them to our LPs. It's like, what? Like if you select the right subset of investors, they will pay more than the entire set of investors. It's like weird. And I think that like it's hard to understand the reasons for that. And I wrote about some, and people emailed me with more. And like there's some good, there's some arguments that like if you took the subset of investors who know the company the best, they will pay a higher price than if they're like competed down by short sellers, right? Or like they're competed down by like the noise of the public market, and they're like, oh, I don't want to deal with that noise. But it's weird, right? It's weird that you would pay a higher valuation for something that you can't trade than for something that you can trade. And I think this notion of paying for illiquidity, which I associate with Cliff Asness has written about this in like a derogatory way, because he's like, don't invest in private equity, invest with me. But like, I think that this notion of paying for illiquidity is like counterintuitive, but like, I don't know. I find a lot of people are like, yeah, that's probably it. Like there's probably something to that where people are paying for not having to look at a market price. Part of that is like, I've written about it like psychologically of like, if you don't have the opportunity to sell. You don't see a market price, you don't sell, and so you're protected from your own mistakes. But part of it is just like, structurally, like if you have like a traded asset, you will hold it in a form that is liquidity creating. You will like be a mutual fund and people can take their money out, or you will like get a margin loan, right? And like you'll hold it in some form where when the market goes down, you'll be a forced seller. Whereas like with private funds, unless you're Alameda Research, you're unlikely to be a forced seller just because like you can't sell it, right? And so like you have like that dynamic. But it's weird. It doesn't make it's weird. It doesn't make a ton of sense, and it's like an artifact of a strange
Wait a
bifurcated
minute,
market.
it's sort of interesting. People buy real estate because they think it's more stable.
Right, exactly.
And it
exactly.
isn't.
Right.
Because when we have, I've done the research on this. When we have 50-year history of equity REITs, real estate investment trusts, and they're just as unstable as the S&P 500. But people, you go to people and say, "Oh, I'm going to buy real estate." Why? Because it's more stable than the stock market.
But by the way, it is more stable.
Which it is not. But they think it is because they get quotes every 6 months or 1 year. They never have to, when there's stress in the system, they don't get a quote, and so they don't think it's unstable.
But also because like when they're thinking about how they're going to finance it, they say, "Well, I'll get a 30-year fixed rate mortgage," right? They're not like, "I'll get a margin loan," right?
Right.
Some of it is like the financing structure that naturally goes with the illiquid asset is not going to make you a forced seller. And that's, by the way, not always true. And you have like,
Right.
like floating rate mortgages in the financial crisis, but like it's like largely true. And I think there is something to that of like the natural financing structure for the illiquid thing makes you not a forced seller. But it's still not a good reason intuitively to pay more.
But I mean, the evidence, we in economics, generally find more liquid assets sell at higher prices. I mean, the classic example is, on-the-run bonds versus off-the-run government bonds. A 29-year bond sells, at a lower price than a 30-year bond, even though, there's virtually no difference. And because a 30-year bond is just much more active and people like it and they will trade it.
Sure.
So there's evidence that goes back, hundreds and thousands of years about the liquidity premium.
I think there's anecdotal evidence now of things like EQT saying these companies are worth X, and the public market will pay, 80% of X for them, right? And it's like, then they're not worth X, right? But like, EQT thinks they are. EQT's like, our LPs think they are. Our LPs will transact with us at those prices. So, I don't know.
Yeah, I had Cliff actually right in this room here like 10 years ago, and he told that story about the illiquid private, the story about the volatility. But also another story he told, which I'm curious if this rings true from experience with the financial crisis, is that during the financial crisis, in any public company, any publicly traded financial company, everyone was watching the stock of their company on the screen, their own wealth going to zero while they're trying to get their work done. AQR, private company, no stock, no price on the screen. People were doing their jobs. I don't know that felt that was a.
I have a tangential anecdote about that, which is that I used to work at Dealbreaker, the financial gossip blog, and like when AQR was laying people off in 2008, Cliff was reading Dealbreaker and writing long, angry comments about Dealbreaker's reporting on the layoffs. So he was not as undistractable as he might make himself out to be. But don't repeat that to him. But no, it's true, and I think that like that was a theme in like March where like one thing that very much fed into the failures of SVB, and then like the ricketiness of other regional banks is people looking at the stock price, right? And it's like it's a feedback
mechanism. Yeah,
where like and I think literally in SVB's case, like it's very clear that like some number of VCs were like, that stock went down, I'm taking my deposits out, right? And like the linkage was quite clear.
Right. Yeah. Go ahead, right there. Yeah.
Circling back to like the crypto conversation, I know there's a lot of like protocols that are working on like opting roll-ups and like getting to get rid of the transaction. So I guess like there's not a lot, like a lot of people are working on infrastructure, not a lot of people are working on like decentralized applications. Like you guys were referring to like user applications being not like that friendly and not useful. I'm kind
So, like, it's interesting that you say the first thing you say, like, interesting applications or flash loans on Aave, right? Like, I think that, like, when I was thinking a lot about crypto, like last year, I was thinking the interesting stuff in crypto is about financialization, is about, like, building tools for people to trade stuff in cool, fun ways. And, like, the financial system is really into that. And if crypto builds a better mousetrap for that, then, like, eventually that will in some way colonize traditional finance, right? And so, like, one example of that is there's this great crypto exchange called FTX that was, like, building all sorts of cool, like, risk management engines and futures engines. And, like, their long-term plan was to tokenize stocks so that you could trade stocks, but not in the boring old way that, like, Charles Schwab does it, but in this cool new way where it's, like, much more programmable, and you could, like, get flash loans of stocks, and, like, you know, you could do, like, complicated short trades that were all sort of resolved in a single cycle, and, like, you know, do all the really interesting financialization stuff that, you know, Aave would pitch. And then, like, you know, as I was thinking that, FTX was collapsing. And I think that, like, that really set back, like, I think if you go to a bank and you make the case like, oh, the blockchain has all these cool new ways to, like, trade derivatives, the bank's gonna be like, yeah, but, like, all the fraud, right? And I think that, like, the like new financial system case for crypto has been really set back by the financial crisis in crypto. I think the other, like, big case for crypto is, like, you know, people are always like, oh, we're going to build games on it. We're going to build, like, consumer-facing applications. We're going to, like, build a way for you to, like, share your Wi-Fi and get paid for it. We're going to build publications that get paid in crypto. All the just, you know, non-financial companies, non-financial businesses that would live in crypto. And I think there too, like, the games are pretty bad, and also they're Ponzi schemes. Like, so I think that, like, you know, I'm sort of pessimistic on the current state of crypto, which doesn't mean that you should be. It just means that I am, because I think that, like, the stuff that I thought was cool and interesting was, like, the financial stuff, and I just, like, it's just like it's just a smoking crater now. And I think the non-financial stuff I always kind of thought was kind of fake, and still feels kind of fake. And I'm sure there's some brilliant, you know, person in a garage somewhere coding up the next consumer application that will run on the blockchain, and will, like, the blockchain component of it will be, like, integrally necessary in a way that I don't certainly understand, nor do I know what this application is. But, like, you know, in 10 years, like, the trillionaire CEO of that company will be like, yeah, I was, you know, when crypto crashed, I was working in my garage to build this great thing, just like, you know, Amazon, you know, emerged from the crash of 2000. But, like, I don't know. I think it's a kind of interesting thing, but I just like, I don't, like, I think the, like, I think leaving aside that it's somewhat hard to put real world assets on chain in a way that, like, crypto people don't always appreciate. I think that real world assets on chain is interesting in a world where there is a huge, robust crypto financial system that is competing with the traditional financial system, and where you know, a crypto investment bank is like, we have set up a platform for trading these, you know, houses on chain, and hedge funds can get into it, and it's like a robust ecosystem. But when it's just, like, you know, a crater, then it's not, right? Like, I don't think there's anything inherent. Like, I think a lot of crypto people think that there's something inherently interesting about putting real world assets on chain. I do not. I don't think that there is, like, I don't think there's any, like, deep magic between having, like, mortgages recorded on a blockchain as opposed to having mortgages recorded on a, like, centralized database run by DTCC. I think that what's interesting is, like, if you build, like, a really exciting financial system that people want to come to, then, like, putting more assets into that financial system is potentially productive and transformative. But if you build a financial system where everyone's in prison, then it's not.
Way back there, sorry.
So to your first question, I mean, I think it's a negative of the margin, but I also think that it's not like London or the Bahamas are like living in a paradise of like consumer-facing crypto applications, right? Like it's not like I have like 10 great crypto projects that I'm like, oh, if only Gary Gensler would let them go, right? Like I think, if I knew of those great crypto projects, we'd have a different conversation. On Gary in general, I think he has. I think the perception in the crypto industry maps exactly to the perception in the private funds industry, which maps exactly to the perception in the activism industry, which maps exactly to, there's like two others, right? High frequency market makers, my God. They're all like, this guy has an agenda that does not involve listening to industry participants, and that if you come in to tell him why clause X of unity regulation will destroy your business for no purpose, then he will listen to you and you'll leave, and he'll turn to his aides and say, make that much worse. Like, this is the perception that like people in the industry have. And by the industry, I mean all financial industries. So, I don't know.
We have only like a few more minutes here. Go ahead, right? Go ahead, yeah.
Hi, Matt. So in the past, you mentioned like SoftBank a couple of times. I'm just curious, what's your take right now on SoftBank Mutual Fund, especially with about the and maybe it's a reflection of the general business and the factors right now. I also have a second question. Like, what is one question that you want people to ask you that people haven't asked you yet? And what's your answer?
Gosh. SoftBank, I don't know. I mean, like, SoftBank was just a punching bag for me for a long time because it was, it's such a pure, like, metonym for, like, the excesses of I guess the word is VC. It's kind of like growth. It's kind of like late stage growth. You know, it's like not really VC, but like, it was very much like, you know, you ask like, why should there be a disconnect between public and private company valuations? Like, another answer that like we hadn't really talked about is just like a market segmentation one, where like if you run a asset manager and you have $100 billion to put into privates and $200 billion to put into publics, then you know you're to some extent price insensitive within the, you know, to like in the difference between those categories because of just like how your money has been raised. Like SoftBank had $100 billion to put into privates, and they're like, okay, let's go nuts. So I think that's probably a little bit unfair to them, and I think they've obviously dialed it back in various ways. But they're a great, like, when you say the word SoftBank, everyone knows what you mean, and you mean that. I don't have a great answer to your second meta question. I don't have a great answer to it. No, I don't know.
Time for one more question, I think. Over there? Go ahead.
What is your view on ESG investing, and do you see it growing in the future? Do you think that finance can help solve climate change and like social inequalities, stuff like that?
I think you were in a really, really weird time for it, where it's still like, you know, ESG is like a large and growing component of like the European regulatory landscape, and like, you know, a lot of demand from a lot of, you know, allocators, while also being quasi-illegal in the United States. So that's weird. I don't know. I think that ESG investing as a business got a lot of tailwinds from conflating two things, which are like thinking about long-term, let's say, climate risks as a financial risk to the businesses we invest in, right? Like, a lot of people who run investment funds are like, I want to make sure that my portfolio is robust to climate risks, right? And then there's also like socially responsible investing, which is like, I want to make sure that my portfolio makes the world better, right? And I think that a lot of ESG investors who are fundamentally doing the first thing and like thinking about climate risks were a little loose about talking about the second thing because it was just great advertising, right? It's great advertising to be like, you know, we're making the world better. And so they would necessarily
effective altruism.
Yeah, like they wouldn't necessarily say it in so many words, but they'd be like, oh yeah, like, you know, ESG had this like warm halo effect in addition to being, you know, a way to manage long-term financial risks. And then like, you know, US Republicans got a hold of that and they're like, no, it's bad to care about the climate. And so now you have this weird thing where the BlackRocks of the world are like, okay, guys, we don't care about the climate. We're not trying to cut back on fossil fuels, but as responsible stewards of our investors' money, we do have to consider the long-term risks to their money. So we have to think about like these like you know, and so you have people, there's some guy in some story who was like, I want to rebrand ESG as like material risks, right? It's just like, because that's like the thing that you're doing is you're sort of considering long-term risks in like one pocket of ESG investing. But then there are other people who are like socially responsible investors. And I think that like it's put people in a real bind because they're like, we can't, as fiduciaries, stop considering these risks, but like Ron DeSantis told us we can't consider them anymore. So I don't have a good answer for like what the long term. I think that like the long term trend is for investors to consider those risks, and we are in a weird, controversial setback where part of the solution is for investors to walk back some of the rhetoric they had in like 2020 and say, we're just considering long term risks. We're not trying to make the world a better place with your money.
Jeremy, I'm curious to hear what you have to say about them, and then we have to.
Yeah, well, you know, I do have a chapter in my book, Stocks for Long Run, on ESG investing. And two things. I mean, this is a broad scale. I mean, if climate is in your utility function, I mean, and it should be, because your ability to enjoy wealth might depend on the state of the climate, then you will start investing not on just the basis of, you know, risk-return covariance structures. You know, you would have to take that, you invest in investments that would go up if climate went worse, and that would be utility maximizing in a pure, you know, way. So, you know, if climate goes into your utility function, then climate should have a separate category. As far as the governance and, you know, the other thing, you know, if you like fair traded goods and you're willing to accept an inferior risk return trade-off, but you're willing to do that because you think you're doing good for the world, fine. I mean, now, I know you're talking about whether someone else is making that judgment for you. I'm just talking about if you yourself are setting your own portfolio and, you know, care about certain things. Climate, if it is in your utility function, actually could make yourself better off. The other thing is you'll get a worse risk-return trade-off, but I feel good because I'm investing in something that I think is good. So, I mean, there really is a pure theory. You know, and Rob Stambaugh, who's, you know, a faculty member at Finance, I mean, he has written a lot about it, and I was in very close contact with him when I wrote the chapter on the book on ESG investing.
All right, well, let's we need to end now, so let's have a round of applause for Jeremy and Matt. Thank you so much for joining us. Thanks. All right.